You know that feeling, right? The market just whipsaws you. Feels like you're on a small boat, stormy sea.
Oh, yeah, definitely.
One day, everything's soaring. You feel like a genius investor. Picked all the winners.
Top of the world.
The next, bam, everything plunges suddenly. And you hear these terms, right? Analysts on TV, they're all saying risk on or risk off. Like, it explains everything.
Like it's some magic switch.
Exactly. But what does that actually mean for you, the American investor trying to figure out your 401k or your brokerage account?
It's a fair question. It can sound like jargon.
And how do these headlines, things that seem totally unrelated sometimes, a tweet about tariffs maybe, an inflation number, one little sentence from the Fed chair,
How does that trigger these huge, sometimes really violent market shifts?
it feels chaotic, but there's often a logic underneath.
It feels like there's this hidden psychology maybe,
Oh.
or some deep mechanic driving it all, beneath the daily noise. I think you've hit on something really crucial there. It's definitely not just random noise. These swings, they're often about a collective shift, a change in the investor mood, a widespread feeling about what's coming next.
A mood swing, basically,
Yeah.
for the whole market.
Exactly. And that mood is incredibly sensitive to news, to incoming information. Or like you said, sometimes it's the lack of clear information that creates the uncertainty that drives the mood shift.
Right. The not knowing can be just as bad. Okay, so welcome everyone to the deep dive.
Glad to be diving in.
Today, we are really getting into this critical idea, market sentiment. Specifically, that big swing between the risk-on mood and the risk-off mood and how it plays out right here in the U.S. market.
And we've got quite a stack of material to work with today.
We really do. We've pulled together articles from seasoned market commentators, some really detailed financial analysis reports, and even dug into some academic economic research papers that crunch the numbers on this stuff.
So our mission today isn't just to define the terms, right? We want to go deeper.
Much deeper. We want to unpack what specifically defines these market states. What do our sources say investors actually do when they feel confident versus when they're feeling fearful?
And how do different kinds of news stories, policy, economic data, whatever, actually trigger those specific reactions?
Yeah, and crucially, what signals can you, the listener, actually watch in the market? Concrete things that help you see which mood is dominating right now.
Think of it like trying to decipher the market's underlying emotional rhythm. It gives you a much better framework than just reacting, in the heat of the moment.
Okay, let's start unpacking this foundational concept then. First up, the core definitions. What are we talking about? Let's begin with risk-on sentiment. What does that state actually look like?
So at its heart, risk-on is really a state of confidence. It's when investors, broadly speaking, are feeling optimistic.
Optimistic about what, specifically?
About the economy, mainly. The economic outlook looks good. They feel the financial system is stable. Maybe policy seems predictable. They just feel comfortable taking on more exposure.
Exposure to riskier things.
Exactly. Assets that offer higher potential rewards, even if they know those assets come with more volatility, more uncertainty.
So risk-on is when the market is feeling good. Feeling kind of brave, maybe.
Brave is a good word for it.
Yeah, precisely. And when that confidence level is high, our sources consistently show investors tend to move their money, their capital, into specific kinds of assets.
You're hunting for something specific.
They are. They're looking for higher yields than they can get from the really safe stuff, and they're chasing growth, future prospects.
Okay, so what are the go-to assets then? In a risk-on world, according to our sources.
Well, the most obvious one is the stock market, right?
Yeah.
Equities. When confidence is running high, people are willing to buy shares. They're anticipating companies will make more money, share prices will go up.
Makes sense.
What else? Commodities are another big area. Think oil, copper, things like that. They're often tied very closely to global economic activity. So when growth expectations are strong, demand for commodities tends to rise and prices follow. Okay, stocks, commodities. You mentioned currencies earlier too. That one seems maybe less intuitive for someone just focused on their stock portfolio.
It does, yeah. But it's actually a really powerful signal if you watch it. Certain currencies are seen as being much more sensitive to global growth, to risk appetite.
Which ones are we talking about?
Our sources point frequently to the Australian dollar, the AUD, and the New Zealand dollar, the NZD.
Why those two?
Well, their economies are often linked quite closely to commodity exports, to global trade flows. So when the world economy looks strong and investors are feeling confident, buying things, trading things, demand for those currencies tends to pick up.
Interesting. What else fits the risk-on bill?
Emerging market assets, that's a classic one. So stocks, bonds, currencies in developing economies.
Why are they considered risk-on?
Because investors perceive more risk there, right?
Mm.
Political risk, economic instability maybe, but for taking on that extra risk, they see the potential for much higher returns than in developed markets. So when they're feeling brave, they allocate more capital there.
Okay, let me try to summarize the risk-on picture then. Confidence is high.
Yeah.
Investors want growth. They want yield. They pile into stocks, commodities, currencies like the Aussie and Kiwi dollars, and emerging markets. They are actively taking on risk.
You got it. That's the essence of risk on.
Now let's flip that switch. What about risk off? What defines that mood?
Risk off is basically the complete opposite psychological state. This is when fear dominates, uncertainty, anxiety.
What are they afraid of?
Potential negative outcomes could be an economic slowdown, maybe even a recession, geopolitical instability, wars, trade disputes, maybe unpredictable government actions, or worries about the financial system itself, like a banking crisis.
So their priority changes completely.
Dramatically. It shifts from seeking growth to just trying to preserve the capital they already have. Job number one becomes, don't lose money.
They're running for the hills, essentially, looking for safety. So where do they typically hide out in the market?
They flock to what are pretty universally recognized as safe haven assets. Our sources highlight the usual suspects, the perennial favorites.
Like what?
The Japanese yen, the JPY. It's long been seen as a safe store of value during times of global stress. Partly that's because Japan is a major creditor nation.
Okay, the yen. What else?
U.S. Treasuries, government bonds issued by the U.S. Treasury. Historically, these have been considered the benchmark safe asset globally. They're backed by the full faith and credit of the U.S. government.
The ultimate safety net, usually.
Usually. Then there's gold, the ancient store of value, right? Demand for gold typically shoots up during uncertainty. Investors like its perceived safety, its independence from financial systems.
Makes sense. Any others?
The Swiss franc, the CHF, another classic safe haven. Switzerland has that long history of political neutrality, financial stability. That gives the franc credibility.
So in a risk-off panic, the money flows into Japanese yen, U.S. treasuries, gold, Swiss franc.
Got it. And didn't one of our sources also mention the U.S. dollar itself as another safe haven?
Yes, absolutely.
Yeah.
The USD often benefits from this flight to quality.
Why is that? Well, think about it. So much global trade, so much international finance is conducted in U.S. dollars. And U.S. financial markets are incredibly deep and liquid. It's easy to buy and sell U.S. assets. So when things get scary globally, holding dollars or dollar-denominated assets feels safe and accessible.
Okay, but you mentioned a wrinkle earlier, a time when the dollar didn't act like a safe haven.
Exactly. And this is where things get really interesting based on our sources. We definitely need to talk about a very recent and quite unusual situation where the dollar did not behave like a typical safe haven. It complicates the simple story.
Ooh, okay. Building the suspense. We will definitely circle back to that exception. But first, you stress these shifts aren't just random market vibes. They're triggered by specific things, right?
They really are. Our sources are very clear on this. These swings in sentiment, these rotations between risk on and risk off, they rarely just happen out of the blue. They're often direct reactions to significant catalysts, things happening in the real world.
Like what kind of catalysts?
Could be major news announcements. Think unexpected economic data releases, maybe inflation numbers being way off forecasts, or surprising political developments. Could be changes in central bank policy, especially from the big ones like the Federal Reserve here in the U.S.
The Fed's decisions always move markets.
Always. Or it could be sudden, large-scale economic shocks, something that fundamentally changes the outlook, like the start of a major conflict or a natural disaster impacting supply chains. These events basically alter the collective perception of risk versus reward, and that's what flips the switch between risk on and risk off.
Got it. So risk on, confidence chasing growth. Risk off, fear chasing safety. And specific news or events act as the triggers. But okay, how do you, the individual investor listening right now, actually see this happening? How can you tell which mood the market is really in beyond just watching the S&P 500 go up or down?
Right. That's the practical question. And this is where the signals come in. Our sources point to several key indicators that act almost like market sentiment thermometers. They show you the underlying flow of capital, the flow driven by that collective mood.
Okay, give us some examples. Where should people be looking for these signals?
A very clear place to look, especially if you follow or trade the foreign exchange markets, is currency pair movements, Remember those currencies we just talked about? The risk-on ones like AUD and NZD, and the risk-off ones like JPY and CHF?
Yep, the ones investors buy when they're feeling brave or sell when they're scared.
Exactly that. So when the market is firmly in a risk-on mood, feeling optimistic, you'll typically see those currencies associated with higher yields or growth or commodity exports. You'll see them strengthening relative to the safe haven currencies.
So the Aussie dollar would go up against the Japanese yen.
Precisely. The AUD-JPY pair would likely be rising. Or the New Zealand dollar, the NZD, might gain ground against the Swiss franc, the CHF. What's happening is traders are selling the safe haven currencies to buy the riskier ones that they think offer higher returns in that environment.
So if I'm just casually watching the AUD-JPY currency pair online and I see it steadily climbing, that's a pretty strong signal the global market is feeling more risk-on.
It's considered a very strong signal, yes. Our sources specifically highlight AUD-JPY as one of the most frequently watched cross-currency barometers for overall global sentiment. When AUD-JPY is rising, it generally signals improving risk appetite. When it's falling, it signals increasing risk aversion. Traders are moving money out of the more volatile Aussie dollar and into the perceived safety of the yen.
Are there other pairs like that?
Yeah, several others mentioned serve a similar function. Often they have the JPY as the second currency, the denominator, because a move into JPY signals that flight from risk. So you might watch NZD-JPY, USD-JPY, UR-JPY, even CHF-JPY. Though that pits two safe havens against each other, the dynamics can be complex. The key is understanding which currency in the pair is generally seen as the riskier or more growth-sensitive one at that moment.
That makes a lot of sense, actually. It's like watching this tug-of-war between safety and risk playing out in real time, just by looking at currency values.
It really is. It's a direct reflection of capital flows. Another key signal, of course, is the performance of those traditional safe haven assets themselves.
You mean gold and treasuries?
Exactly. Gold prices tend to move inversely to risk sentiment. During risk-off periods, when fear is high, you'll typically see gold prices rising as investors pile in, seeking that perceived safety.
And treasuries, how do they signal the mood?
U.S. Treasuries behave similarly, although we have to keep that recent nuance in the back of our minds. But historically, during periods of nervousness, demand for treasuries surges. People want that safety. This increased demand drives treasury prices up, which means their yields go down.
Right. Priced and yield move opposite for bonds.
Correct. So people are willing to accept a lower return, a lower yield, just for the security of holding U.S. government debt. A sustained drop in treasury yields is often a classic sign of increasing risk aversion in the market.
Okay. Currencies, gold, treasury yields. What about the VIX? People always call that the market's fear gauge.
Absolutely. The VIX, the volatility index, it's calculated based on options prices for the S&P 500 index, and it's basically interpreted as a measure of expected market volatility over the next 30 days.
So how does it relate to risk-off?
It tends to spike sharply upwards during risk-off phases. Why? Well, when fear and uncertainty are high, traders expect bigger price swings, more volatility. This expectation gets reflected in how they price those options contracts, and that drives the VIX calculation higher. A rapidly rising VIX is like a classic flashing red light for increasing market anxiety.
Okay, let me see if I can put these signals together then. If you see, say, the AUD-JPY currency pair climbing, maybe gold prices are falling, treasury yields are also falling, meaning bond prices are rising, and the VIX is low. That whole picture points towards a risk-on environment.
Generally, yes. That combination would strongly suggest investors are feeling confident.
And conversely, if AUD-JPY is falling hard, gold prices are shooting up, maybe treasury yields are also falling sharply, and the VIX is spiking. That's a screaming risk-off signal.
That would be the classic textbook risk-off picture, yes. Looking at those signals together paints a much richer, much clearer picture of the underlying forces driving the market than just watching your stock portfolio's value bounce around.
It feels like getting a look under the hood.
It does. But as I hinted earlier, this is where we hit that really fascinating and I think crucial nuance that was highlighted by one of our sources, specifically the AP source we looked at. It shows that while these signals are typically reliable guides, market reactions aren't always perfectly textbook, especially when the source of the fear is unusual.
Ah, yes, you're talking about that weird behavior with treasuries and the dollar you mentioned, where they didn't act like safe havens.
Exactly that. The AP source pointed out that in one specific recent downturn, a period where the S&P 500 was down significantly, clearly showing a broad market retreat, something really unexpected happened with two of those traditional safe havens.
Which two were acting weirdly?
U.S. government bonds, treasuries, and the value of the U.S. dollar itself. They also sank right alongside the falling stock market.
Wait, that just sounds wrong based on everything we just laid out.
Hello?
Treasuries and the dollar are supposed to be the ultimate destinations, the shelters when investors get scared. They should be going up when stocks go down.
It is totally counterintuitive, isn't it? And the source explicitly describes this as an unusual move. The historical pattern, the playbook, is that during nervous episodes, global investors pile into U.S. treasuries and the U.S. dollar. That demand drives up bond prices, pushing yields down, and increases the dollar's value relative to other currencies. Flight to quality.
So if the usual run-for-cover assets were also falling, what did the source suggest was going on? Why did the market go off script like that?
The source posits, and this is really thought-provoking, that in this specific instance, the fear driving the market decline wasn't rooted in the usual suspects, like general economic worries or a banking crisis spreading globally.
Okay, so what was driving the fear then?
Instead, the source suggests the fear was driven directly by policies coming out of Washington.
Policies from Washington causing treasuries and the dollar to fall.
That's the implication, and it's profound. The idea is that these specific policy actions may be seen by the market as unpredictable or maybe detrimental to long-term economic stability, potentially eroded the market's confidence in the absolute safety and reliability of U.S. treasuries and even the dollar in that specific moment.
Wow. So the fear wasn't just general global jitters. It was fear of the actions coming from the very place that issues the world's safest assets.
Yeah.
That must fundamentally change how an investor thinks about safety.
It absolutely does. It highlights that the origin of the fear really matters. When the source of the uncertainty is perceived to be domestic policy from the world's largest economy, the issuer of the global reserve currency, well, that can create a really complex reaction where those traditional safe haven flows get disrupted. It complicates that simple risk-off playbook quite considerably.
It really does. It's a key piece of that rethinking fundamentals idea you mentioned we'd get to later, isn't it?
It ties directly into it, yes.
Yeah. Okay, that unusual observation is a powerful reminder of how nuanced these sentiment shifts can be. Let's dive deeper now into how specific types of news events, these catalysts you mentioned, actually trigger these investor reactions and the subsequent sentiment shifts. Maybe start with something that's been a huge topic recently, tariffs and trade policy.
Right. One of our sources, a report from BlackRock Insights, specifically identified a structural change in the international tariff and trade regime as, and they use this word too, an unusual catalyst for a recent market correction.
They also called it unusual. Why is a shift in trade policy considered an unusual catalyst compared to, say, a recession hitting?
Well, think about it. A recession is often seen as part of a natural, albeit painful, economic cycle. But a major shift in tariffs and trade rules, that's a deliberate policy choice. It fundamentally alters the rules of the game for businesses, for global supply chains, in a way that's not cyclical.
Okay, so it's man-made uncertainty, essentially.
Exactly. And the source stated this wasn't just some fleeting headline risk. It had a deep impact because it directly undermined already fragile investor confidence. News like that, especially coming from a major global economic power like the U.S., just ripples outwards. It affects consumer spending plans, corporate investment decisions, and critically, it hits investor sentiment hard.
So policy news directly impacting the market's overall confidence level.
Precisely. And the source noted that this specific type of geopolitical or policy risk initially led to what they called a classic risk-off rotation. So investors, faced with this new unpredictable uncertainty about how trade would work, they initially moved capital towards those safe haven sectors and assets we talked about.
Like utilities, staples, stocks, maybe gold, certain currencies. The typical defensive moves.
Presumably, yes. That initial reaction followed the script.
But wait a second. Let's connect this back to that weird treasury and dollar behavior we just discussed.
Yeah.
If this same policy risk originating from Washington also contributed to treasuries and the dollar sinking later, how does that fit together? That seems contradictory.
And that's where the complexity really comes in. It seems the same underlying source of uncertainty, policy decisions about trade originating from Washington, might have simultaneously triggered two things. First, the initial instinct for a classic risk-off move into safe havens.
Okay, the Pavlovian response.
Right. But second, perhaps it also started to erode confidence in the most prominent U.S.-based safe havens themselves, treasuries and the dollar, precisely because the uncertainty originated from Washington.
So it's like a flight to safety, but maybe also a flight away from the source of the instability, even if that source is usually where safety is found.
That's one way to interpret it, based on putting those pieces together. It suggests that policy coming from the very core of the global financial system can disrupt those established safe haven patterns in unexpected ways. It's a powerful demonstration.
That paints a really intricate picture. It's definitely not just simple cause and effect. It's a layered, sometimes conflicting reaction, depending on the news itself and where it's coming from. Okay, what about inflation and broader economic data? How does news on that front typically drive sentiment shifts?
Our Morningstar source gave us a really clear breakdown of this. It explained how a series of economic reports came out that were stronger than expected, particularly reports on inflation and jobs.
So the economy looked hotter than people thought.
Exactly. And this caused investors to suddenly reassess their assumptions about the future. All at once, investors became more concerned about inflation in 2025 than they had been just a short while before.
That sticky inflation narrative that just won't go away.
Right. That's the one. The source describes this chain reaction. You have this persistent, sticky inflation combined with really robust job growth numbers. That combination suggested the economy was running hotter, maybe too hot, than previously thought.
And that changes things for the Fed, right?
Absolutely. This combination started reshaping the Federal Reserve's outlook for rate cuts. If the economy is strong and inflation isn't cooling down quickly on its own, the Fed is suddenly much less likely to feel the need to lower interest rates to stimulate activity. They might even feel they need to keep rates high or go higher.
So investors had to adjust their expectations.
Rapidly. They shifted to anticipating that the Fed would probably need to hold interest rates at a higher level for longer than the market had previously priced in.
Okay, and how did the market actually respond to that big shift in interest rate expectations?
Well, according to the source, both stocks and bonds struggled to adjust to the new outlook. It hit both asset classes.
How did it hit stocks?
In the equity market, those sectors that are particularly sensitive to inflation and rising interest rates, think technology stocks, other high-growth stocks whose future earnings get discounted more heavily when rates go up, they tended to underperform.
And bonds. You said they struggled too.
Oh, yeah. The bond market saw significant turmoil. Remember, bond prices fall when interest rates, or the expectation of future rates, rise. So bond yields started climbing significantly. The source specifically noted the 10-year Treasury yield pushing up towards 4.8%, which was its highest level since way back in October 2023.
Wow. So even if the Fed hadn't actually done anything yet, just the expectation that they'd keep rates high for longer, triggered by that economic data, was enough to push bond yields way up.
Absolutely. The bond market is always trying to look ahead, to price in the future path of interest rates and inflation. It reacts instantly to shifts in those expectations.
Did other bond market signals confirm this?
Yes, the source also highlighted that other key bond market indicators were flashing red on inflation. Things like inflation swaps, the break-even inflation rate, which is the difference between yields on regular treasuries and inflation-protected treasuries, TPS, and also the term premium.
Term premium, what's that again?
That's basically the extra yield investors demand for the risk of holding a long-term bond compared to just rolling over short-term bonds. When that goes up, it often signals increased uncertainty about inflation or future rates. All these signals confirm that inflation expectations were becoming a major concern for bond investors at that time.
And this kind of uncertainty can feed into broader fears too, right? Like recession worries.
Exactly. As another source, the one from AXAM, noted, this kind of economic uncertainty, especially around inflation and rates, can definitely fuel broader recession fears. Fears predicated on collapsing business and consumer confidence, which is another powerful driver pushing sentiment towards risk off.
Okay, so it's clear. Economic data directly feeds into expectations about monetary policy. Those expectations then trigger significant reactions across both stocks and bonds, ultimately influencing the dominant market sentiment, risk on or risk off. Which leads us perfectly, I think, to arguably one of the most powerful catalysts of all, actual monetary policy actions by the Federal Reserve. Some of our academic sources really drilled down into this one.
They did. And this is where the research provides some genuinely counterintuitive insights that challenge common assumptions. Their focus is very specifically on the impact of unanticipated Fed actions. the surprises.
Why the focus on surprise? Doesn't the Fed usually try not to surprise the market? They give forward guidance and all that.
They definitely do try. And policy changes that are widely expected by the market are usually already priced into asset values before the announcement. So to understand the pure impact of the Fed's action itself, separate from what the market already knew, the research needs to isolate that element of surprise.
How do they measure the surprise?
They typically use futures market data. Fed funds futures contracts reflect the market's collective expectation of where the Fed's target rate will be at future dates. By comparing the actual Fed announcement to what the futures market was pricing in just before the announcement, they can quantify the unanticipated element of policy actions. It's that surprise component that tends to cause the immediate, sharp market movements.
Okay, makes sense. So what did this rigorous academic research find about how the stock market specifically reacts to these Fed surprises?
Okay, here's the finding that might make you scratch your head a bit. Get ready for this one. The research found there is a statistically negative and highly significant stock market response to surprise rate cuts.
Whoa, hold on, wait a minute. A surprise rate cut makes stocks go down. That feels completely backwards. Isn't the mantra always lower interest rates are good for stocks, like rocket fuel?
That is the common assumption, isn't it? Don't fight the Fed when they're cutting. But the study's regression analysis, looking at historical data, shows this clear negative relationship. Based on their full sample analysis, they calculated that a 1 percentage point surprise cut in the Fed funds rate target was associated with a pretty stunning average one-day return of negative 4.68% in the stock market.
A drop of nearly 5% in one day. Just because the Fed cut rates unexpectedly. Why? What does that possibly tell us?
It suggests that when the Fed delivers an unexpected rate cut, the market's dominant interpretation isn't, oh, great, cheaper money.
No. What is it then?
It's more like, oh, no, things must be really, really bad. Maybe the economy is weakening much faster than we thought. Or maybe there's a financial crisis brewing behind the scenes that we didn't see if the Fed felt it had to make a surprise emergency-style cut like this.
So the cut itself becomes a signal of distress.
Exactly. It signals a deteriorating outlook that the market hadn't fully priced in yet. That triggers a wave of selling. The policy action isn't seen as a proactive stimulus in that context. It's seen as a reaction to really negative underlying conditions.
That's a critical distinction. Wow. It's not the cut itself that's inherently bad for stocks. It's the reason the surprise cut was deemed necessary that spooks the market. Are there ever exceptions to this? Does the market ever react positively to surprises?
Yes. Interestingly, the research does note some anomalies. They found instances where equities actually rose despite significant positive funds rate surprises, meaning surprise rate hikes.
Okay, now I'm really getting tied in knots here. Surprise cuts make stocks fall, but surprise hikes can sometimes make them rise. How on earth is that possible?
Yeah. It really highlights just how complex market reaction is, right? It's influenced by way more than just the headline rate number. The source suggests that these counterintuitive instances, where stocks rallied even though the Fed delivered a surprise hike, might happen when the announcement itself, even with the rate increase, is accompanied by communication or statements from the Fed that lead the market to believe something else.
Like what?
Like, maybe this hike is the last one in the cycle, or that the pace of future hikes will slow down dramatically from here.
I see. So the market isn't just reacting to the immediate pain of the hike, it's reacting to the perceived signal about the future direction of policy. The end of the tightening cycle might be in sight.
Exactly. It's the forward guidance or the interpretation of the statement, the hint about what comes next, that can sometimes outweigh the impact of the immediate action. Communication matters hugely.
What about when the Fed does nothing? When maybe the market expected a change?
The research also looked at those policy inactions, instances where the Fed held rates steady, even if the market might have been leaning towards expecting a change. They found the market tends to respond very little, if at all, to these non-decisions.
It's for like a collective market shrug. Like, okay, they didn't move this time, maybe they will next month.
That seems to be one plausible interpretation offered by this study, yes. A failure to move might just be seen as postponing the inevitable, lacking a strong new signal about the future path. They also briefly touch on reversals.
Reversals.
Yeah, situations where the Fed changes the direction of its previous rate movements. So, starting to hike after a period of cuts, or starting to cut after a period of hikes. The suggestion is these reversals might have larger market impacts, but they caution this finding is based on pretty limited historical data.
This is all fascinating stuff about how the market reacts, but the really big question is the mechanism. Why do these unexpected rate changes, particularly those surprise cuts causing declines, impact stocks so powerfully?
Yeah.
What does the academic research say about the underlying channels?
Right, the why. The study used a fairly technical analysis method called VAR decomposition vector autoregression to try and disentangle the different ways Fed surprises ripple through to affect stock prices. And their key finding points towards something called expected excess returns.
Expected excess returns. Okay, need to translate that from academic speak into plain English again. What does that mean for the average investor's perception of the market?
Think of it like this. Expected excess return, or the equity premium, is basically the extra compensation, the extra return that investors demand for taking on the risk of owning stocks compared to holding a theoretically risk-free asset, like a short-term treasury bill. It's the price of bearing stock market risk.
Okay, so it's how much extra return you want for taking the plunge into stocks. So the research suggests unexpected rate hikes make investors demand more compensation, a higher equity premium to hold stocks. Why would that happen?
The analysis suggests that when the Fed unexpectedly tightens policy, raises rates, it might make stocks seem inherently riskier to hold in that environment. Or perhaps it simply reduces investors' overall willingness, their appetite, to take on risk in the market generally.
So it changes their risk tolerance.
Potentially. The study found that the impact of the surprise hike on things like expected future dividends, company profits, or on real interest rates, the cost of borrowing after accounting for inflation, was actually smaller in their model compared to this impact on the required risk premium.
So it's not necessarily that investors suddenly think companies will earn less profit because the hike or just that borrowing costs went up slightly. It's more about how the Fed's action changes the market's fundamental perception of how risky stocks are, or changes their appetite for taking that risk.
That's precisely what their decomposition analysis suggests, yes. Unexpected tightening might increase the perceived riskiness of corporations operating in a higher rate world, or maybe it signals something negative about the future economic climate that makes investors less willing to hold volatile assets like stocks. The big implication here is that monetary policy isn't just a simple lever controlling the cost of money. It profoundly impacts how investors value and perceive risk itself in the stock market. And that changes the return they demand to stay invested.
Wow. That adds a whole other layer of depth to why Fed announcements are always such market-moving events. It's not just about the immediate economic impact. It's about the potential for a deep psychological shift in risk appetite that they can trigger.
Absolutely. It really underscores the power of the signal and the subsequent reevaluation of risk that follows.
Okay, so we've covered tariffs, inflation data, Fed actions. Beyond those, our sources also broadly mention other geopolitical risks as market drivers, right? Without going into extreme detail, maybe.
Yes, that's correct. The AXA-IM source, for example, explicitly notes rising geopolitical tensions in general as being a contributing factor to recent equity market volatility and also to the repricing we've seen in fixed income markets.
So just general global instability.
Pretty much. While our specific source material didn't detail examples beyond the trade tensions we already discussed, the general point is clear and consistent across market commentary. Instability on the global stage, whether it's new regional conflicts flaring up, political crises unfolding in major countries, or international disputes escalating, all of that creates uncertainty. And that uncertainty inevitably feeds into risk-off sentiment. It's like a constant undercurrent that can suddenly surge and cause shifts in market mood.
Right, and another source of potential fear. And finally, before we move to implications, it's probably worth remembering that even when these huge macro-driven sentiment swings are happening risk-on, risk-off news about individual companies still matters a lot, doesn't it? The AP source gave us some tangible examples of that.
Oh, definitely. That's a crucial point. While the overall macro sentiment really sets the tide for the market, determining whether it's generally a time of euphoria or panic, individual company performance and specific news events can still create significant waves for specific stocks, bucking the trend sometimes.
What were the examples?
The AP source noted instances where large declines in individual stocks, like those seen in Tesla and Nvidia at the time, heavily contributed to dragging down a broader index like the Nasdaq.
What drove those specific declines?
Well, the factors mentioned were varied. For some, like Nvidia, it involved concerns about government restrictions on exports impacting their business with crucial markets like China. For others, like Tesla, it might have been related to extremely high valuations coming under scrutiny, or even the impact of actions or public statements by a high-profile CEO, company-specific stuff.
So bad news for a specific big company can actually worsen a broader negative risk-off feeling in the market.
Precisely. They become these concrete, high-profile examples that seem to validate or feed the broader narrative of fear or uncertainty that might already be present.
But it can work the other way too, right? Good company news.
Absolutely. The same AP source noted how stocks like Discover Financial and Capital One saw their prices rise significantly, even while the broader market might have been nervous overall. Why? Because they received specific, positive news, in their case, government approval for their proposed merger.
So that specific positive catalyst outweighed the general gloom for those stocks.
Exactly. It shows that while the macro mood provides crucial context, strong company fundamentals and positive individual events can still lead to significant gains, even when the prevailing market sentiment is cautious or negative. It really highlights that as an investor, you need to pay attention to both the forest, the overall sentiment, and the individual trees, the company-specific stories.
All right, this has been incredibly insightful. We've really dug into what risk on and risk off actually mean. The practical signals you can watch, currencies, gold, yields, VIX, and how all these different types of news, from policy coming out of Washington to inflation data to the surprising Fed moves to global tensions and even individual company headlines, how they can trigger these powerful, sometimes complex, and occasionally counterintuitive shifts in investor mood. So, bringing it all back home now to you, the investor listening. What does all this actually mean for managing your money? How can understanding these market mood swings help you navigate these often really turbulent waters?
Yeah, the so what question. Our sources offer some very concrete strategies, actually, for investors who are looking to position themselves, especially in periods that are characterized by uncertain growth prospects and elevated volatility, which seems to be the kind of environment described in much of our source material recently.
Okay, what kind of adjustments are they recommending people consider?
Well, the advice from BlackRock provides a strong starting point. They suggest, particularly relevant in the current environment they were analyzing, that investors should continue to avoid more volatile stocks.
Meaning the high beta names. The more speculative stocks, maybe smaller caps.
Exactly those. Their analysis indicates that these types of stocks rarely outperform when growth is decelerating and volatility elevated. Basically, when the overall market mood is nervous or fearful, these riskier names tend to get hit first and often hardest.
Okay, so if you're avoiding the volatile stuff, where should investors be looking instead, according to BlackRock's view?
They recommend focusing on companies that exhibit consistent revenue and earnings. Businesses with more predictable financial performance, less prone to huge swings.
What makes revenue and earnings consistent?
Preferably, they like companies that operate in repeat businesses. Think about businesses whose revenue streams are less sensitive to short-term economic fluctuations or sudden changes in consumer spending habits. Things like subscription models, maybe, or providers of essential services that people need regardless of the economy.
Can you give us some specific examples, sectors or types of companies they actually mentioned?
Sure. They pointed to areas like lower beta megacap tech and adjacent names, including enterprise software.
So big established tech companies.
Yes, but specifically those whose business models are often based on sticky, long-term enterprise contracts. That makes their revenue streams potentially more consistent than, say, a company selling the latest consumer gadget. They also suggested looking at select healthcare companies.
Why healthcare?
Because spending on health is often seen as non-discretionary, right? People need healthcare services and products regardless of whether the economy is booming or busting. The overall focus, as they termed it, is on finding high-quality, low-vol, stable growers.
Okay, so companies that might not promise explosive high-risk growth, but offer reliability and stability instead.
Precisely. That reliability becomes highly valued when overall uncertainty is high. And they also reinforce that in a classic risk-off trade, you typically see capital flowing into those traditional defensive sectors, consumer staples, companies making everyday necessities, utilities, healthcare, and of course, the safe haven asset gold.
So the big strategic advice is, when the market feels risk-off or just generally uncertain, pivot towards quality, towards defensiveness, towards predictability.
That's certainly a core part of the strategic thinking presented. Then ACY Securities offered some more tactical advice, which aligns directly with actively identifying the prevailing sentiment using those signals we discussed earlier.
What's their tactical approach?
They basically suggest aligning your short-term moves with the dominant sentiment. So if you've looked at the signals AEG, JPY, gold, VIX, etc., and you identify a strong risk-on environment currently prevailing.
What might you do then?
Well, your tactical moves might include looking for opportunities in those high beta currency pairs like AUJPY or URJPY that tend to rally and risk on. Maybe increasing your exposure to equities generally, perhaps even considering shorting gold as gold prices often fall when risk appetite is strong. And focusing on trend following trading strategies because momentum is likely to be a powerful factor in a risk on rally.
Okay, and what if the signals are all flashing risk off instead? What are the tactical considerations then?
Then you'd consider doing the opposite, essentially. Selling those currencies associated with growth or risk appetite, like the Aussie dollar, the Kiwi dollar, maybe emerging market currencies.
And buying what instead?
Buying the traditional safe haven currencies, like the Japanese yen and the Swiss franc. Increasing your exposure to gold. Being much more cautious about stocks, perhaps even looking for opportunities to short the market if you anticipate sell-offs accelerating.
What about bonds in a risk-off scenario?
Potentially buying long-duration government bonds or ETFs that track them, aiming for capital preservation. Although you'd have to keep in mind that recent unusual behavior we discussed, where policy fears complicated the Treasury trade. But traditionally, long bonds are a risk-off destination.
So the tactical idea is use the signals to read the market's mood and then align your shorter-term portfolio adjustments or trading strategies with that dominant sentiment.
Exactly. It provides a more objective framework for making decisions in the moment, rather than just reacting emotionally to scary headlines or sharp price movements.
That makes sense. But you mentioned there was a broader, maybe even more crucial point from the BlackRock strategists, something that echoed that unusual policy-driven fear.
Yes, and this is potentially quite profound. They suggest that the current environment, which is marked by deep uncertainty, particularly uncertainty driven by policy choices and geopolitical factors, means investors might need to fundamentally rethink the fundamentals of how to invest.
Rethink the fundamentals. Wow. That sounds like a call for a pretty major shift in approach, not just tweaking things around the edges.
It really is. One source quotes them saying something quite pointed. We can no longer extrapolate from past trends or rely on long-term assumptions to anchor portfolios.
That's a direct challenge to traditional buy-and-hold investing, isn't it? Strategies based purely on decades of historical performance data.
It certainly seems to be. The implication is that the underlying dynamics of the global economic and political system might be changing in significant ways, making those long-term historical patterns potentially less reliable predictors of future returns than they once were.
So the old playbooks, the ones that worked for the last 20 or 30 years, might not work as well going forward.
That's the concern being raised. They argue that the traditional distinction between short-term tactical adjustments and long-term strategic asset allocation is becoming increasingly blurred. Instead of setting a long-term portfolio allocation based on fixed assumptions about correlations and returns, and then just letting it ride for years, they suggest there's now a greater need to constantly reassess the long-term trajectory and be dynamic with asset allocation as we learn more about the future state of the global system.
That sounds like it requires a much more active, much more engaged approach from investors, even long-term investors.
Yeah.
Less set it and forget it.
It absolutely does. It demands more adaptability, a greater willingness to adjust your core portfolio mix more frequently than maybe you would have in the past, especially based on how the fundamental landscape is evolving, particularly concerning these big policy and geopolitical risks we've been discussing.
Any other implications of this rethinking?
Well, they even raised a possibility that might surprise some people, tying back to that policy uncertainty point. They floated the idea that investors outside the U.S. might increasingly choose to keep more of their capital invested in their own home markets, rather than automatically defaulting to U.S. assets as the primary destination.
Why would they do that?
Particularly if policy uncertainty originating from the U.S. continues to complicate the traditional role of U.S. treasuries and the U.S. dollar as the ultimate global safe havens. If the core safe assets become less predictable, it might change global allocation decisions.
That's a really striking thought. It underlines just how significant the shifts we've discussed could potentially be for global capital flows in the long run.
It definitely speaks to the potential for deep, lasting changes in investor behavior driven by these new kinds of uncertainty that seem to be dominating the landscape.
Wow, this has been a truly deep dive, getting right into the market's, well, its emotional core, it feels like. So let's try to sum up the absolute key takeaway from this whole discussion. Market sentiment, that collective mood swinging powerfully between risk-on confidence and risk-off fear, it's not just some vague concept floating around. It's a fundamental driver of asset prices. across all markets, stocks, bonds, currencies, commodities.
Absolutely. And crucially, these shifts, these mood swings, they aren't just random bursts of emotion hitting the market. They are typically specific reactions, often triggered by significant news events. Whether that news is about policy changes like tariffs altering the global trade landscape,
Or critical economic data like inflation numbers reshaping everyone's expectations for growth and what the central banks might do.
or the Fed's own monetary policy decisions, especially those unexpected ones that carry so much signal.
Or even just broader geopolitical tensions, creating a background hum of instability.
Yeah.
All these things can flip the switch.
Right. But, and this is so important, the market's reaction isn't always a simple, straightforward one-to-one response to the news.
No, definitely not. As we saw.
It involves investors trying to navigate surprises, trying to interpret the nuances of communication, like from the Fed, and sometimes dealing with highly unusual behavior, like that really telling instance of U.S. Treasuries and the dollar sinking alongside stocks, apparently because the fear itself originated from U.S. policy.
So understanding why these shifts happen is key. Is it a classic flight to safety driven by economic fear? Or is it something more complex, like an unexpected policy move impacting investors' willingness to bear risk and changing the very return they demand for holding stocks?
Understanding that why is absolutely crucial if you want to make sense of market volatility and position yourself strategically or even tactically. It's not just about blindly following the trend. It's about trying to understand the complex inputs, the news, the data, the psychology that create the mood behind the price movements you see on the screen.
It really is about trying to decipher that emotional rhythm we talked about at the very beginning, and maybe, just as importantly, recognizing when the music itself might be changing fundamentally.
Precisely put.
Okay, so here's something to really mull over as you think about your own investments, building on everything we've discussed today. A final provocative thought. If policies coming out of the very heart of the global financial system, Washington, D.C., can potentially cause assets traditionally seen as the absolute safest bets in the entire world, assets like U.S. Treasuries and the U.S. dollar, to stumble and fall during a downturn, what does that truly imply about the very nature of safety in global financial markets going forward? How should you fundamentally adapt your definition of what constitutes a safe asset in a world where policy uncertainty isn't just some minor background factor, but potentially a primary disruptive driver of fear itself?